Hello and welcome back to All Things Money. I'm your host, David Blain. We thank you for joining us today. If you missed the first segment, you missed a good one. We talked a little bit about gold and gold as an investment, which we don't define it as an investment. Yes, it has been a store of value. It's kept up with inflation over the years, and it could possibly be, some sort of alternative currency. But in terms of a pure investment, we do not recommend it as part of a well-diversified portfolio. If you missed it, head on over to the website, dlblain.com, and you can listen to the whole segment. During this segment, I want to talk a little bit about hedge funds. Now, hedge funds are investment vehicles, they're private investment vehicles, unlike an open-ended mutual fund that maybe some of you are familiar with, that people invest money in, and there's a manager that invests in public securities, and they make all sorts of filings with the SEC, and they're a well-regulated entity. A hedge fund has a little bit looser rules, and so has traditionally been something that is reserved for accredited investors. Well, part of the restrictions on hedge funds is they have never been allowed to market directly to the public or consumers. But recently, the SEC is widely expected to lift this prohibition and allow hedge funds to go directly to the public to market and advertise. Currently, hedge funds you find out about hedge funds through referrals, personal referrals, private banks, wealth management firms like us. We don't advocate investing in hedge funds. However, if someone needed to, we have access to them. But that's how people get invested in hedge funds. You won't see an advertisement on TV for them. You won't see an advertisement in the newspaper, direct mail, or anything. The investor must be accredited, and I don't think this is going to change, but you must have a net worth exceeding $1 million, excluding the value of your residence. And there's another tip in there that your home is a place to live, not an investment. So it's $1 million, not counting your residence, or more than $200,000 in annual income the past 2 years. The average investment for a lot of these hedge funds is $1 million, and managers typically charge a large management fee, somewhere around 2%, plus they normally charge a percentage of the profits. If the wider marketing is approved, hedge funds can bypass some of these middlemen and go right to the investors. This really comes out of the Jumpstart Our Business Startups Act of 2012 that Congress passed as a way to try to jumpstart small businesses and attract new funding. But there are some real issues with this. Hedge funds are very different investments. They're not very transparent. They utilize strategies. Most of them use some sort of leverage involved. And just because someone has $1 million in investment, I think this is where some of the rules need to be updated, does not necessarily mean they're a sophisticated investor. I mean, I've met people with, $100,000, $250,000 that were very knowledgeable of the markets, very knowledgeable of investing. And we have people, we've also met people that have several $1 million that are not that knowledgeable, that make poor decisions with their money. And so just because someone has a dollar amount of money does not mean they're a sophisticated investor. And I think it's a danger them passing this rule and allowing them to market directly to the consumer. You see a lot of other things, consumers that do not make smart decisions, and this is one that I think could have the potential to definitely harm people. Now, it doesn't look like the accredited investor status is going to go away, so you still have to have $1 million net worth or $200,000 in annual income. So that should help shield some people. But that's probably the next target that they'll go through. If you are in that category and you're thinking about hedge funds, by all means contact us, and we have some what we call due diligence checklists for funds. You'll want to follow a distinct process of evaluating the fund, trying to figure out if it's right for you and your personal circumstances. You want to look at things such as, what's their strategy? Some hedge funds can do all sorts of different things. Some are what's called global macro, meaning they move money from, say, stocks in Europe to U.S. stocks to bonds to commodities, and they shift money all over the globe very rapidly. Other hedge funds are what we call arbitrage funds, meaning that they look for arbitrage situations, sometimes in currency. There was a big the yen trade that was going on. Other times they'll try to arbitrage announced mergers when a company announces that it's getting bought out or something like that. There are hedge funds that focus on bonds. There are hedge funds that focus on commodities. You also want to look at the leverage that they use. You know, are they using leverage? Are they borrowing money to invest is a big factor. You want to look at the manager. What's their track record? You know, what have they done in their life? A good example, the hedge fund manager, John Paulson. He made one huge bet on the mortgage crisis and made himself a multi-billionaire. And so then he went out and started these different hedge funds, and one of his hedge funds was big into gold, which if you missed the first segment, go listen to the first segment where we're talking about gold as an investment. And Paulson, his gold fund, I mean, lost people tons of money. So there was somebody that, you know, he had the hot hand on Wall Street, so he set up a hedge fund, but he didn't have a long track record. So if this applies to you and you're thinking about doing it, make sure that you understand what you're investing in. The other thing is a lot of them have long lockup periods, and you invest your money, you can't get it out, but maybe once a quarter, once a year, or something like that. So there's a lot of caution to that. We'll keep an eye on that rule. When we come back, we'll talk a little bit about how playing defense, the risks are up for defensive investing strategies in the current market environment.